Today I want to talk about what to me is a very interesting topic, and that is futures markets. But let me just start. I want to give you an example, and we'll see better what I'm talking about. But let me just first comment just on this word, derivatives. To people in finance, derivatives are an exciting development of financial markets. We start out with a simple market, and we develop derivative markets that add more detail and information than was in the underlying or primary market. So I'm going to start with agricultural futures in talking about this. And I want to start also with a very it's not homely, it's a very elementary example because it's the first futures market. So where do you think futures markets started? Anyone have You would think it started in New York or Chicago, right? But or London, right? Or Paris. It actually started in Japan, in a place called Dojima, which is in the city of Osaka. And they started in the 1600s. So let's just go back, if we can go back to the year 1673 in Osaka, Japan. Japan was heavily dependent on rice, okay? And the rice farmers would farm all over Japan, but there was a rice market in Dojima, which was the national rice market. And I have data here, according to a study, there were 91 rice warehouses in Dojima in 1673. That's a long time ago, isn't it? All right. So it was a big storage place for rice, and they were storing it all year. And people would come, and they would, people who were merchants for rice, they would come to Dojima, and they would sign contracts to get rice. You know, I mean, I live in some town 20 miles from here. I'm a rice merchant. I need a regular supply of rice from your warehouse. Can you supply it to me? And the guy would give you terms. And that would be a forward contract, okay? And this is what was happening before the futures market. Forward contracts precede futures contracts, okay? So do you see what it is? You're a rice merchant, you make a deal, you sign a contract that I will pay you so much in currency every month, and you'll give me so much rice, and you'll deliver it here, and I'll take it and I'll sell it in my town. Problems developed in the forward market that led to the development of a futures market. And the problem is, I'll tell you, one of the problems is that there's counterparty risk. You are a rice merchant, you make a deal with a warehouse, that's one person dealing with one person, right? What if one of the guys reneges on the deal? So for example, what if the price of rice falls? Then you, the merchant, will say, I'm not going to go back and buy according to this contract because it's cheaper now, right? I'll buy it somewhere else. So I just don't show up. And then the warehouse is saying, what happened to our contract? And you're nowhere to be found, okay? Or if it goes the other way, if the price goes up, the warehouse might renege, right? They'd say, you know, we've signed this contract, but there's something wrong with it, and we're not going to honor it. So it messes up. It is also possible that one of the two counterparties is just a sociopath or something, or is an alcoholic, or something is wrong. So the market doesn't work well. So what they invented in Japan was the first true futures market. The market worked like this. There was a trading floor in Dojima, and rice traders would come there, and there were certain hours of the day when you would trade contracts for future delivery. But they were standardized contracts mediated by the exchange so that there would be no problem with the contract. And then every day there would be a trading time, and you could buy and sell contracts for future delivery. Moreover, they enforced trading hours. And this is something that's kind of an interesting invention. They didn't have I guess they didn't have clocks. I don't know what they had. But they had a certain time when trading would stop, and they wanted to stop all the trading at the same time. They didn't want people dribbling out. They wanted it to be a good market. So they would light a burning fuse. They would light a fuse. It would be a bright light in the middle of the trading floor. And you'd see the fuse burning down, and when it burned out, all trading stopped. So they had trading hours. Moreover, they had a problem that some of the traders wouldn't stop trading. So this is something that they did in Dojima. They had men called watermen who came out with buckets of water, and they would throw the buckets of water on anyone who was still trading. So that worked. It stopped trading. They also had hand signals. It got so... This was big. This was big time. You were trading rice for all of Japan. And you may think the 16 or 1700s are long ago, but a lot of rice was traded. And it got really noisy and difficult. They found that it was... So many people were trading on the floor that you couldn't hear anyone talk. And they would be shouting and noisy. And so they devised a system of hand signals. And the Dojima hand signals were... I don't know exactly, but something like this. If your hand was out, you put your hand out, that means sell. Put your hand this way, it meant buy. And if you put 3 fingers up, it means selling 3 contracts. That kind of thing. I don't know the whole system, but that's where it started. That whole concept was copied all over the world in subsequent centuries. So what is it that happened? Now, the other thing is, what were the contracts that you bought and sold? The problem with the forward market is that the contracts are all different. They're not, one guy made a contract with one guy, and he says, I want my delivery here, and I don't like this kind of rice, I want this kind, and you better make sure that there's not a single insect in it, or I'm going to reject the whole thing. But that's all different, so you don't know these contracts, you don't even know what the price of rice is. If someone said, I paid so much to get rice, but you have to say, well, under what circumstances, and what kind of rice, and where, and what are the terms for possible failure, and there's so many terms in the contract, so you don't even know what the price of rice is. But at the futures market, they standardize the contract. So it may not be exactly what you want, but it's standardized. So you deliver rice. Now, I don't know all the details of Dojima, but I'm talking about futures markets as they evolved. In a modern futures market, agricultural futures market, you deliver the contract is to deliver some commodity like rice at a specified future date at a specified future warehouse, okay, which would be run by the exchange. And there's inspectors at the warehouse who are expert on grain. And they verify, because they know rice, they know it really well, and they know that some rice has bugs in it. They know how to find out. They have a standard. Of course, there can always be some bugs in it, right? But they have a standard, and they have a way of measuring, and they get it right. And so all those contracts are exactly the same. And so they become the price. It turns out, funny thing, the futures market almost becomes the real market because they're all standardized. The futures price, you know where it's delivered, you know what's delivered exactly. And so if people the futures market becomes the market in a sense. The fact that it's in the future is in effect a help because since it's a comfortable time in the future, it's well defined. Whereas the spot market, the spot market is the market for rice or whatever it is today as it's traded, okay? The spot market is inscrutable. It's hard to understand. So let's think about a farmer today who grows rice or wheat or soybeans or something. If you drive through farming countries, listen to the radio, regularly they'll give prices, soybeans, wheat, rice, etc. Why do they give that? Because farmers care. They're raising this stuff. It's their whole livelihood. Whether they make a profit or not depends on it. What prices do they quote? They quote the futures prices, even though they're in the future. But they quote them because they mean something and they're standardized. So that's why the futures market becomes the central market. Now, one thing I wanted to say about futures, also, which I didn't really clear. In forward markets, which are markets between a pair of counterparties, there's always counterparty risk. I'll write that. That means you've got a contract, you had a lawyer wrote up the terms, you can take this guy to bankruptcy court or something, but that's all a nuisance and it costs money. You never know. Futures markets get rid of counterparty risk, or essentially get rid of it. And how do they do that? The system is one of, it's a standardized retail market that anyone can play in, but you have to post margin, and that's the idea. Margin when you either buy or sell futures. Okay, so this is what happened. This is what a futures contract looks like. You can do this. I don't know what would happen if you called up a broker at your age, but essentially you can do this. I know Jeremy Siegel, my friend, said he would actually lend money to students and let them play the markets. His own money. I have never done that, so don't ask me to do that. But you can basically call up a broker and say, I'm interested in rice futures. It sounds like fun to me. I'd like to play that game. So the broker would say, fine, I'll open a margin account. How much money are you going to put in? All right? The first question is money, okay? He doesn't know who you are, but money talks, okay? So you say, all right, you have to come up with some money to do this. Let's say I'll put in $5,000 into a futures account at your brokerage. And he would then say, okay, now you have $5,000, and the margin requirement for rice futures, I don't remember what it is, say it's something like 3% or 5%. You can buy or sell up to the limits imposed by your margin. Your margin has to be whatever percent of the contract that you sign, okay? And then I'll let you put, you can buy, if you're only putting up $5,000, I'll let you buy and sell $100,000 worth of rice. So that's what happened when you say, okay, I want to buy, what do I want to do? I'm going to store rice and then I want to sell it. So I want to sell futures. It doesn't matter whether you buy or sell. Either way, you've got to put up money now. So let's say I'm going to do this rice storage business. So I've got my own, I can do it. It's open to anybody in the world. I can find a warehouse, I can buy some rice, I can store it, and I can sell it at that price. So I want to sell futures, okay? I can sell $100,000, even though I've only got $5,000 put up. But then you know what happens? Every day they look at the change. Now, the futures price is the price on that contract today, but it's not a price you pay today. You would pay it at the end, effectively, when the contract comes due. Or in the case of selling, you'd be receiving it. So if I sell futures for, say, May of 2012, then I am promising to deliver rice to the warehouse in Chicago on that date in 2012 and take the price, okay? Okay, but now the futures price today is the average, is the price that the market has today. Tomorrow the futures price will be different. And so what they have in the futures markets is daily settlement. And that means that if I sold futures, as I'm storing rice and selling futures, if the price goes down, if the price goes up, it works against me because I've locked in the lower price. So the broker debits my margin account by the daily, every day they change my margin account. So if I've sold futures and the price goes up, they take it out of my margin account. If the price goes down, they put it into my margin account. And I can quickly deplete my $5,000, right? Suppose price keeps going up. Then I say, gee, I wish I hadn't signed that contract because, I could have waited a few days and gotten a better price. Meanwhile, the broker calls you on the phone and says, I'm sorry, your margin account is almost depleted. Do you want to put up more margin? And this is where you get the reality of futures trading because there's no counterparty risk. That means that if you don't put up more margin, the broker closes you out. and says, here's your money. Do you understand how this works now? So there's no counterparty risk because even it doesn't matter whether you're a drunk or a sociopath. The broker has you trading, and it doesn't matter at all what you do. Once you put up the money, and if you just don't answer the phone, if you say you don't answer the phone, the broker will close you out when the margin is depleted. So the broker takes no risk. The counterparty is not even given to you. You don't even know who is on the other side of that contract because the other side is you're both making a contract with the exchange. And so you don't care about counterparty risk, and there's no risk to this contract. That means these prices are pure prices, and they don't have any counterparty risk. But I wanted to just give a little bit of simple mathematics about futures pricing, and then so the basic formula is that you have to think of futures markets as storage markets, and the basic equation is that the price in a futures contract, P sub F, is the futures price on one of those dates, is equal to 1 plus R plus S times the spot price. Okay? Where the spot price, P sub S, well, I'll write it out, P spot, is the price today. Okay, now this is kind of theoretical because I've just told you nobody ever knows what the price today is anyway, because the only way you ever know prices is through futures market. But let's just think a little bit abstractly. Say there's a cash market for wheat that it's bought and sold with, and we know what the price is on that market. This is the interest rate between now. It's not the annual interest rate. It's the total interest as a percent between now and the maturity of the contract. Okay? So if it's 1 year and the interest rate is 5%, then R is 0.05. But if it's 1.5 years, it's going to be more like 0.075, right? Because the total interest between now and 1.5 years in the future is 7.5%. And S is the storage cost. Okay. So this is called fair value. And what it means is normally you think futures prices should behave like that, okay? And all right, so the normal situation in futures markets is contango, which means that prices are normally going up through time because the longer in the future we're looking at, the longer time that we're losing interest and storage. See, what this really is, this fair value equation is just the equation that defines when it is that there's just no profit to storing grain, right? There's only a normal profit, right? If people who do it, this equation can't hold exactly, or if it held exactly, then no one would store grain, but it has to be approximately valuable, okay? So do you see, so how else to say this? That it shows that normally the futures price is above the spot price. And as time goes on, now I don't mean time in this sense, I mean calendar time, the futures price will converge on the spot price because the interest rate, the horizon for the interest rate and the storage cost, this is in percent, and this is in percent, goes down. So let me just clarify that. Let's talk about a perfect world where there's no harvest uncertainty, nothing happens except the crop is normally produced, okay, and it's wheat, okay? And let's say I'm going to do a plot through, and this is time. This is calendar time, not maturity time like on this plot. And this is the price of this. I'm going to plot well, I'm going to plot the price of wheat. So what does wheat do over the year? It has a seasonal. I'm going to do an abstract form of a seasonal. This is what the price of wheat does, and this is a year. This is year 1, this is year 2, this is year 3, year 4, all right? This is the price of wheat in each of these years. It falls every harvest time, right? It has to be rising until harvest because somebody has to be storing grain and the price has to go up because they're facing storage costs. And then every spring, every harvest time, it collapses. And it does it again every year. No uncertainty. What do futures prices do? Well, let's consider a futures market that's a futures contract that has a maturity right here at the peak, just before the harvest, okay? Well, if there were no uncertainty, the futures price would just be constant throughout that whole time, right? It would always equal the expected spot price on that future date. And again, it would repeat the next year. So I'm looking at futures contracts have no expected price change in this perfect world. But do you see what I'm saying? This equation always holds because as this contract matures, the time to the expiration date goes down. And so this R goes down and S goes down. And it eventually hits 0 on the expiration date. And the futures price equals the spot price on the expiration date. But in reality, we don't see such a nice and perfect match. I just want to finally conclude with financial futures, which I didn't emphasize in this lecture. But we also have futures markets in financial commodities, and I'm just going to tell you about one of them. It's called the S&P 500 futures market, index futures. And now, in effect, you have to deliver not oil or rice or wheat, but you have to deliver the S&P 500 index. How do you do that, by the way? How do I deliver 500 stocks? Well, there's a procedure, and it's called cash settlement. It's different. Instead of showing up at a warehouse with your trucks full of wheat, you only show up with the money. And so because they don't expect you to do that with stocks. The other thing about what is the storage cost for stocks? Well, it's actually negative. It doesn't cost me anything to buy. If I buy a share in a company and store it, it doesn't cost. It's a negative cost because they pay a dividend. So the fair value, and this is what you'll see quoted all the time on CNBC or any of these business Bloomberg or these business networks, is so the futures price is equal to 1 plus R minus Y times the spot price. Same formula. This is the interest rate. And this is the dividend yield. Okay? So now whether the futures price is above or below the spot price is less clear here because it depends on whether the interest rate is higher than the dividend rate or lower. At this point in history, for short time horizons, the interest rate is less than the dividend rate. We have about a 2% dividend yield on stocks, and we have essentially a 0% interest rate. So for short horizons, we'd expect to see the futures price less than the spot price in stock index futures. But at longer horizons, I think that would be reversed. But this market is very clear. The fair value relationship is highly predictive of futures prices in the S&P 500 index futures because there's always storage of stocks. We never deplete the warehouses of stocks. So they're always there. And so that means that the futures curve is less interesting for stocks than it is for oil. All it does is reflect fair value. And so it's not like oil where the storage situation is very complicated and is constantly changing. So, you know, in a sense, the S&P 500 index futures is not so much about the future, is not so much about, the futures curve is not so much about the future of the stock market. So don't make the mistake of looking at the futures curve for the S&P 500 and thinking, I'm going to forecast the market using this curve. You can't. Basically, the S&P 500 is very hard to forecast, and the futures curve doesn't do you anything because all it reflects is fair value.